Welcome back to Investing Talk Podcast.
Today we're looking at Amazon.
And honestly, looking at the stack of notes here, the stakes feel incredibly high. It feels less like a standard review and more like we're watching a battle play out in real time. On one side, you have this promise of a, sci-fi future, AI, robotics, and on the other, the very harsh reality of the bill that's coming due.
It really is a clash of narratives. And right now, if you look at the price, the market is choosing fear. Amazon stock, it's been in a steep decline, down about 18%. And if you check the forums, there's genuine panic out there.
Panic might be an understatement. I was looking at the historical data, and we are approaching the longest losing streak for Amazon since 2006.
Wow.
Yeah, we're talking potentially 9 straight days of red. That is historically ugly. So the question is this a generational buying opportunity, or are we staring at a falling knife? As usual, before we start, subscribe, like, and comment to this video to support the show.
Okay, so let's get into the nuts and bolts here. Because if you just looked at the top-line numbers from the recent Q4 report, you'd be confused. You'd think they missed by a mile.
Right, because on paper, it didn't look like a disaster. The headline numbers seemed, well, fine.
Oh, better than fine. Sales were up 14% year over year.
Yeah.
And we have to pause here and just appreciate the scale.
Yeah.
For a small company, 14% is.
Yeah.
It's okay. But for a company the size of Amazon, growing at 14% is like an elephant sprinting. It is so hard to move that needle.
So the retail machine, the boxes, that's still humming along, but usually Wall Street isn't looking at the cardboard, they're looking at the cloud.
Exactly. The real story, the engine, was Amazon Web Services. AWS revenue there grew roughly 20% year over year.
And 20% is solid, sure, but I have to play the skeptic. Is 20% enough? I mean, we see Microsoft and Google posting higher growth rates. Is Amazon slowing down?
See, that's the nuance a lot of people miss, and it's critical. It's not just the number, it's the context.
Okay.
This growth happened despite severe capacity constraints.
Capacity constraints? You mean they literally ran out of computers?
Effectively, yeah. Think of it like a popular nightclub. There's a line of billionaires outside waving cash, but the club is full. Amazon is leaving money on the table because they literally cannot build fast enough to meet the AI demand.
So that 20% could have been higher.
Oh, significantly higher. It signals just massive pent-up demand.
That's a good problem to have, I guess. But that brings us to the other engine you highlighted, advertising. I feel like people still forget Amazon's a huge ad company now.
It's their secret weapon. It's high growth. And more importantly, it's a high-margin business.
Let's pause on high margin. Why does that matter so much?
Well, think about retail. To sell you the toothbrush, they have to buy it, store it, pack it, drive it. The margin is tiny.
Right.
But an ad slot, once the platform is built, it's basically pure profit. So as the ad business grows, it does a lot of heavy lifting for their operating profit heading into 2025.
Okay, so you've painted a rosy picture. Revenue's up, AWS has a line around the block, ads are printing money. But now I have to stop you.
I knew you were going to go there.
Because we have to talk about the elephant in the room, and it is a $200 billion elephant.
You can't avoid it.
I have to. This is what's scaring everyone. Let's talk about the cost of all this growth. The guidance for 2026. Capital expenditure or capex. Amazon is guiding for roughly $200 billion.
That is a staggering amount of money.
Staggering. It's astronomical. That's more than the entire value of most companies in the S&P 500. And we're already seeing the hit to their cash flow.
You're talking about the free cash flow dip.
I'm talking about the free cash flow crater.
Fair point.
Okay, so let's define this. Operating cash flow, that was great, up 20% to almost $140 billion. But free cash flow,
right?
That's what's left after you pay for everything. And that number, it dipped to $11.2 billion in Q4.
Yeah.
Down from $38.2 billion the year before.
That is a massive drop. There's no sugarcoating it.
It's a huge deterioration. They're just taking all that profit and dumping it right back into hardware. From a shareholder's view, that's money that isn't coming back to me right now.
It's a shock. I agree. And that shock is exactly why the stock is down. But you have to look at what they are buying. This isn't money being set on fire. That $200 billion is for AI data centers. This is the moat.
But is it a moat or is it a money pit? We've seen companies overspend on infrastructure before. Remember the fiber optic bubble?
That's a valid fear. But here's the difference. The demand is already there. Remember the nightclub? They aren't building an empty club hoping people show up.
Right.
They're building an extension because the line is getting longer. They see the backlog in AWS growing roughly 40% faster than their revenue.
So customers have already signed on the dotted line.
Exactly. The order book is swelling. If they don't build the data centers, they can't sell the product. They have to spend.
Okay, so they're forced to spend. But let's look at the valuation. You think the market's mispricing this risk?
I do. The stock is trading at roughly 28 times forward earnings.
And just to clarify, that means you're paying $28 for every $1 of expected profit. Is that cheap?
For Amazon,
Yeah.
it's historically cheap. For a tech leader like this, that is below the typical multiples. And analysts are projecting earnings per share to hit $7.72 for 2026 and then jump to almost $9.30 in 2027.
So if you believe those numbers, you're buying a company that's about to see a profit explosion once the spending cycle is over.
Precisely. It's a clear path, assuming they execute.
Assuming. That's the key word. Okay, so fundamentals are messy, but the market's reacting to the price action too. The line is going down.
Yeah, the psychology of the market is in the driver's seat right now.
Let's pivot to the charts because it's not a pretty picture, is it?
It's hideous. If you're a chart watcher, you're probably covering your eyes.
We've seen an 18% drop. That's erased. Get this. $470 billion in market cap. Just poof, gone.
Little bath.
And we are nearing that record losing streak. When I look at a chart like that, I don't see a discount. I see a falling knife. Why try to catch it now?
See, that's where I see it differently. You see a falling knife, I see a capitulation low.
Capitulation. That's a strong word. You think the sellers are just done.
Exactly. When you get a move this violent, down 20% year to date, you enter a state where the stock is just psychologically oversold. Everyone who's nervous about that 200 billion capex number, they've sold. They're out.
So the weak hands have folded.
The weekends are gone, the tourists are gone, and usually when that last panic seller hits the button, that sets the floor. From this level, around $207, I see a setup for a massive bounce.
How massive?
We could see 40 to 65% upside. The stock could just snap back to its mean once the narrative flips.
That's a bold call.
I think the broader market turmoil is masking the underlying strength here. When people realize the spending is actually investing in a 40% backlog, the pendulum swings back fast.
Possible. But right now, the narrative is definitely not on your side.
Moving on to what the market is thinking.
Well, let's look at the mood. I did a quick sweep, and it is grim. You see articles asking, is Amazon stock a good buy? And the conclusion is basically, no, run away.
Well, the stock is plummeting. Financial news often just reflects the current price. It's red, so the articles are negative.
True, but the overall sentiment is neutral to bearish. That capex angst is real. People are worried.
The retail investors are worried, yes. But if you look at the smart money, the picture changes completely.
Okay, what did you find?
I was digging through the 13F filings. You know, the big funds have to disclose what they bought and sold.
Right, peeking at their poker hands.
Exactly. And I saw a massive move by Seth Klarman.
Seth Klarman, a Baupost group.
The very same.
For those who don't know, Klarman is a legend, a deep value guy. He is not a tech hype investor. He buys $1 for 50 cents.
Precisely. And in the Q4 2025 filing, Klarman allocated 9.28% of his entire portfolio to Amazon.
Wow, almost 10%. That's not a small bet. That's incredibly high conviction.
It's massive. When a legendary value guy like Klarman steps in and makes Amazon a top holding while everyone else is selling, that's a signal. It tells you he thinks the market is completely wrong.
That is undeniably interesting. It's hard to bet against Klarman, and I'm guessing Wall Street analysts aren't bailing either.
No, they're not. Despite the noise, the consensus is still a strong buy. We have 49 out of 57 analysts rating it a buy. Bank of America reiterated their buy with a $275 price target.
So the pros are buying, the public is selling. Classic setup. But I still can't shake the risk here.
Let's look at the risks.
The $200 billion gamble, I mean, we just can't say that number enough. This is a bet on AI demand continuing to explode. What if it doesn't?
That is the #1 risk. If AI turns out to be a bubble that pops or even just deflates.
Exactly. Then Amazon is stuck with these giant empty data centers, and that free cash flow number stays depressed for years. It could drag the stock down for a very long time.
It's a risk, but you have to weigh it against the cost of not spending. If they don't build, they lose the market entirely to Microsoft and Google.
And on that note, competition is fierce. We've seen at least one analyst downgrade Amazon because AWS is growing slower than its rivals right now.
That's fair. But I would argue Amazon has a history of doing exactly this. Remember when they started building out the fulfillment network for Prime?
Oh, yeah. Everyone said they were crazy. Why are you buying planes? You're a bookstore.
Exactly. Wall Street hated it, said it would kill their margins. But that infrastructure is now an unassailable moat. Nobody can catch them. I see this capex as the exact same play, just for AI.
So you think history is repeating? This is the prime moment for AI.
I do. And there are catalysts people are ignoring. Something called Project Leo.
Project Leo, what's that?
It's their internal efficiency initiative, using AI and robotics to streamline their retail warehouses. The goal is to boost margins in the retail business surprisingly fast.
So using robots to pack boxes and save money?
Exactly. If they can squeeze better margins out of retail, while the high-margin AWS business grows, the whole profit picture improves really fast. It creates a cushion for all that spending.
All right, we've covered a lot. The scary drop, the huge spending, the smart money, the risks.
Time for the final verdict.
I'm really curious where you land. What's your score?
I'm giving it a bullish score of 8 out of 10.
8 out of 10, even with the chart looking like a complete disaster.
I'm looking past the chart. Here's the pitch. You have two incredible engines, AWS and advertising, driving 20% annual operating profit growth. The stock is at a discount, 28 times forward earnings.
Okay.
Yes, the capex is scary, but it's temporary. It is setting up a massive rebound in 2026. This is a multi-year hold.
So you're saying use the red days?
I'm saying use them. If that profit growth hits 20% annually, you could potentially see this stock double by 2030.
Yeah.
You're getting a chance to buy a true compounder at a distressed price.
I have to admit, the Seth Klarman news is the tiebreaker for me. I hate the chart. It looks like it wants to go lower. But when you have that kind of smart money buying and a valuation floor that makes sense, it's hard to bet against it.
It feels like the moment where everyone is fearful, so it's time to be greedy.
The classic line. Well, we will see if the $200 billion gamble pays off. It's going to be a fascinating year. That's it for today's analysis. If you enjoyed this look at Amazon, make sure you subscribe, like, and comment below. Let us know, are you buying the dip or is that capex scaring you away? We want to hear your take.
Thanks for listening.
See you next time.